A tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hello there. Welcome to the Power of Zero show. I am your host, David McKnight, best-selling author of The Power of Zero, Look Before You Lerp, The Volatility Shield, and Tax-Free Income for Life. I am working on a new book. I will tell you more about that in subsequent episodes. All of those books can be bought in single copies at Amazon or wherever you buy fine books. And if you want to buy them in bulk, you want to mix and match various copies and achieve bulk discounts, you can do so at davidmcknightbooks.com. Or if you are looking for someone to help you navigate tax rate risk, longevity risk, all within the very same financial plan, head over to davidmcknight.com. We will hook you up with one of our elite POZ advisors among the very best in the nation at tax-free income planning. If you are an advisor who wants to level up your game and start integrating tax-free planning principles into your practice, head over to powerofzero.com. We'd be happy to have a chat with you. Would love a follow on Twitter as always. It's at McKnight & Co. at McKnight & Co. All right, today I will be airing the first part of an interview I had with Casey Weed, who is with Howard Bailey Financial. He's got one of the top 50 financial podcasts in the nation. We had a wide-ranging discussion during the interview. During the first part of our interview, which you'll be hearing today, we're going to talk about the implications of rising tax rates. We'll talk about what inspired my book, Tax-Free Income for Life. We'll also address how much money in retirement is enough, what's the greatest retirement risk, the psychology of guaranteed income, along with the 4 risks that are lurking in your retirement portfolio, whether you realize it or not. We'll talk briefly on segmented investing, and then we'll wrap up with a discussion on the importance of having an annuity with a piecemeal internal Roth conversion feature. So sit back, relax, and have a listen to part 1 of my interview with Casey Weed.
Dave, welcome back to the podcast.
Thanks, Casey. It's an honor to be back.
Well, Dave, it's great to have you back. I don't know if you know this. I guess I never told you, but you are our #1 most downloaded podcast of all time. We have thousands of individuals that have been able to tune in and get this message about the tax train coming. And I wanted to kick it off first with just kind of reminding the audience what the power of zero is, what the tax train is, what's on the horizon. And then I want to kind of shift over to what's evolved since our last conversation.
Sure, you bet. Yeah. So back in 2015, actually 2014, now that I think about it, I wrote a book called The Power of Zero. We discussed that on your last podcast. And the basic premise of The Power of Zero is that because of unfunded obligations for Social Security, Medicare, Medicaid, the national debt is getting bigger and bigger and bigger. We don't have enough money to pay for all of these things. And so the national debt grows hand over fist every year. We're now at 28 trillion. I would imagine that the last time we spoke, Casey, the debt was only 21 trillion. So we've gone up about $7 trillion. That's a 7 followed by 12 zeros, by the way. $7 trillion in just the intervening 2 years since when we last spoke. Here's the primary problem. The whole reason why we can afford to have so much debt is because interest rates are historically low. What's going to happen, though, as the debt gets bigger and bigger and bigger, other countries are not going to really believe that we're going to have the ability to pay that money back. And so they're going to say, yeah, we'll continue to loan you money, but with the proviso that we get to charge you more interest. Okay. So what's going to happen is we're going to get to the point where we have so much debt, interest rates are going to return to historically normal levels, that the cost of servicing all of that national debt is going to consume the entire federal budget. Forget about Social Security. Forget about Medicare, Medicaid. Forget about the Smithsonian in Washington, D.C. All of these things are going to be above and beyond what we can currently pay for under today's current tax rates. And so a lot of experts have come out and said, look, even in the next 10 years, tax rates will have to increase dramatically or we go broke as a country. In fact, some of them have even said that tax rates will have to double within the next 10 years to keep our country, sort of keep our ship of state afloat. And so the real question becomes, and I addressed this in Power of Zero, is how do people who are preparing for retirement best protect themselves against the impact of dramatically higher taxes, even 10 years from now. And so we turn convention on its ear. We say, look, everybody's been saving the lion's share of the retirement, 401ks and IRAs and other tax-deferred vehicles. In doing so, you are literally entering into a business partnership with the IRS. And every year, the IRS gets to vote on what percentage of your profits that they get to keep. Is that really a smart strategy when it comes to maximizing after-tax income in retirement? So the premise of the book is if you can get to the 0% tax bracket, by the time you retire and then tax rates double, well, 2 times 0 is still 0. So that really is the best way to insulate yourself from the impact of higher taxes.
Yeah, Dave, you've put out more than one book in the tax world, in the tax planning world. And with things evolving so quickly when it comes to taxes, I'm going, how does Dave even keep up with tax changes? You have to put out a book almost every single year in order to keep up with how quickly taxes are evolving. Last time we spoke was the end of 2019, released in March of 2020 on Retire with Purpose. And since then, things have continued to evolve. How do you keep up? Last time we were expecting taxes to go up in 2026. Now it looks like taxes may be going up next year.
I just have to sort of resign myself to having to revise The Power of Zero and my other books every time there are major tax changes. And so, the Joe Biden tax plan is going to be a major, major overhaul on the U.S. tax system. And so we have to approach retirement with a sense of flexibility and the willingness to be nimble and to anticipate potentially what's coming down the road. I know that a lot of people think that tax rates are going to go up. In my book, the updated and revised version of The Power of Zero, I talked about how tax rates for Main Street America are going to go up in 2026. Well, for people who are in the highest marginal tax bracket, their tax rates are almost certainly going to go up next year. But what about everybody else? What about people in the 22% tax bracket? What about people in the 24% tax bracket? Joe Biden he campaigned on this idea that he wasn't going to raise taxes on people making less than $400,000. So if he honors that promise, what does that look like for everyday Americans? And my personal belief is that, hey, if you do make more than $400,000, you're going to pay through the nose. But if you make less than $400,000 as a married couple, or less than $200,000 as a single person, I believe that Joe Biden under budget reconciliation is going to extend those Trump tax cuts for another 8 years. Now, Ed Slott disagrees with me on this. I think there's room there for disagreement, but I believe that if you're trying to insulate yourself from the impact of higher taxes down the road, you're now going to have 8 years starting in 2022 through 2029 to be able to take advantage of these historically low tax rates. Come 2030, we will have kicked the can down the road so much that the federal government is going to be forced to raise taxes. So what my message would be to everyday Americans, people who find themselves in those middle income tax brackets, 22, 24, take advantage of these low tax rates. Stretch that tax obligation out over the next 8 or 9 years. Let's wait to see what Joe Biden officially has to say. Stretch that tax obligation out over the next 8 or 9 years. Keep yourself in a low tax bracket. Get those dollars systematically repositioned to tax-free so that by the time tax rates do go up for good, you've done all the heavy lifting and then can take those dollars out tax-free.
Well, last time we spoke, you shared how those highest marginal tax brackets, I think a lot of the proposals that were on the table at that time said we're only going to tax the rich, which is what we continue to hear out of Washington. We're only going to tax the rich, those with incomes over $400,000. We don't know if that's single filers or joint filers. However, we might regard those individuals as the rich. And you said that those highest marginal tax brackets act as a bellwether for all of the other marginal tax rates. And are you saying now, yes, that's true, but that won't come to fruition for years into the future?
Yeah, historically, that has been the case. And I've quoted Maya McGinnis, who is the president of the Committee for Responsible Federal Budget. She'll be on my podcast this week. And she did a study where she said, look, if you wanted to prevent the national debt from simply growing more than $1 trillion per year, in other words, keep it at $1 trillion of growth per year, you would have to raise taxes on people making more than $400,000 up to 103%. Well, people lose all incentive once they get to the point where they lose all incentive to work once they get to the point where they're giving away 100% of their income. So she said that's obviously not viable. So she lowered the threshold to $250,000. And she concluded that people making more than $250,000 would have to pay 80% tax on every dollar above $250,000. She says that's probably not going to work either. So basically what she concluded was that they would have to lower the threshold to about $40,000. In other words, anybody making more than $40,000 would have to pay 40% tax on every single dollar that they made above that $40,000 threshold. And that's just to prevent the national debt from growing by more than $1 trillion per year. That's not eliminating the growth of the debt. It's not even paying down the debt. It's just preventing the debt from growing by more than $1 trillion per year. So even though Joe Biden has made the promise that he's not going to raise taxes on the middle class, mathematically speaking, it's just not tenable. If he refuses to broaden the tax base for 8 full years, come 2030, we're going to be in a position where tax rates are going to have to be raised much higher on everyone than if he had just put a reasonable plan in place that sort of spreads the tax obligation over a lot more people. And so my fear is that by kicking the can down the road, the fix on the back end is going to be much more aggressive. It's going to be much more draconian, which gives us all the more motivation and incentive to take advantage of these tax rates while they're historically low, because come 2030, I think they're going to rise, and they're going to rise precipitously.
Before we transition into your latest book, I do want to ask the question, because I think about this, I think others do as well. Isn't it a catch-22 though? If they're going to raise taxes that much into the future, they're stifling economic growth, which reduces overall tax revenues. So can they still overcome the deficit by raising taxes if that's stifling economic growth?
Yeah. So what you do is you sort of paint yourself into a corner. You say, okay, we will put ourselves in a position where we absolutely have to have more revenue. So you have two choices at that point. You can either raise taxes on everyone. There aren't enough rich people out there to just tax the rich. You could confiscate all of the wealth of the 1,000 billionaires in the United States, and it wouldn't be enough to really run the federal government for more than a couple of years. So you can either do that or you can print money. And the problem with printing money is that all of the programs that are driving the national debt, Social Security, Medicare, Medicaid, they're all tied to inflation. So if you print more money to try to solve these problems, then you drive up the cost of these programs because they're all tied to inflation. You print money, inflation goes up, the cost of these programs go up. So it's like a dog chasing its tail. You never really have enough money to pay for this non-discretionary spending that the Congress is required to pay for by law. So there aren't a lot of good choices, which is why every year that goes by where Congress fails to act and to put a permanent solution into place that's viable, that's tenable, that is not just a patch, the more draconian the fix on the back end. So this is why I like talking about this stuff, because we have to sort of raise the warning cry to our politicians. We need leadership in Congress to say, look, enough is enough. If we don't do something now, then the fix down the road is going to be even more difficult and trying for Americans in every tax bracket.
Well, I don't want to sit here and debate politics for an hour. I'm sure we could, and what the government should do. We should reduce spending, increase taxes. What should we do? However, I think the moral of your story is that we're trying to eliminate that risk. We're trying to make that risk of rising taxes irrelevant so we can focus our efforts somewhere else. And I think that's what you get to in your new book, Tax-Free Income for Life, which we're going to give away to our audience here in a little bit. First of all, what was really missing from the Power of Zero that led you to write Tax-Free Income for Life?
Well, I'll tell you a quick story. I start off the book with this story, and it's a study done by Harvard Business School. And they basically went to people that had $1 million and they said, do you feel like you have enough money? And they said, no, we don't feel like we have enough money to last through retirement. And then they asked the second follow-up question, how much money do you think you would need to feel comfortable like you'd have enough money to last through life expectancy? And they said, well, I think if we had 2 million, we would feel pretty comfortable. So roughly double. So they said, that's interesting. They took note of it. They then went to people that had $2 million and said, hey, do you think you have enough money? You think you have enough money to last through life expectancy? And they said, no, we don't have enough money. We wish we had 4 million. So they went to people that had 4 million. They wish they had 8 million. Those who had 8 million wish they had 15 million. Once people had about $15 million, they no longer feared running out of money. And so, of course, this study begs the question, do you need to have $15 million in your investment portfolio to feel like you won't ever run out of money before you die? Or is there a different way to sort of mitigate this risk of running out of money, or what we call longevity risk? So that is the sort of the premise of the book. And what I realized at the end of The Power of Zero is we do a pretty good job of showing readers how to mitigate tax rate risk. You get to the 0% tax bracket. But as much as I hate to admit it, when people get interviewed and they complete these surveys all across the country, they ask them the simple question, what is your greatest fear in retirement? You know what, Casey? It's not taxes. It's actually longevity risk. It's the fear of running out of money before they run out of life. And so I thought that to really complete the circle, I had to show my readers how to mitigate tax rate risk and longevity risk within the very same financial plan. It turns out in today's financial planning world, there's not a lot of people that talk about doing that. It's a lot harder than it looks. And so the book is basically a roadmap on how to mitigate both longevity risk, the risk of running out of money before you run out of life, and tax rate risk within the very same financial plan.
What is it between individuals that I meet that have $500,000 and they feel like they have enough money to last the rest of their life, not concerned at all about running out of money? Then I've got clients that have $10 million and they are terrified of running out of money. From a high level, what is your assessment? Why do you think that there is this dichotomy?
Yeah, I don't know. I think a lot of it comes down to what are the guaranteed streams of income that you have in your life. So you may have someone who has $500,000, but they also have Social Security, which is a guaranteed stream of income. It's adjusted for inflation. You might also have a company pension from a company you worked for that is also a guaranteed stream of income adjusted for inflation. And the combination of those two things might be plenty to meet all of your basic living expenses. And so people may say, hey, look, I may only have $500,000, but I have my main nut covered. I'm going to be able to always have food on the table. I'm always going to be able to have electricity. I'm always going to have a roof over my head. But in the very same breath, you may have someone who has $10 million that doesn't have those same streams of guaranteed income. And they feel much more insecure about how long their money's going to last.
That's a really interesting assessment. As I think about those clients that I have that are maybe in that $500,000 range, those over the $10 million range, those that are super wealthy, they don't feel they have a need for guarantees. So they tend to lean more towards higher risk investment strategies. Whereas those individuals that have less in net worth, they lean more towards those guarantees. And this could be a lesson for those super wealthy out there. And I think that's a good lead in to, you share the two greatest retirement risks. You say it's tax rate risk and then longevity risk. And you said in there, saving more money won't solve the longevity risk issue. And I think some will be taken back by that. They said, well, doesn't more money solve everything?
Yeah, it's not about your assets in retirement, it's about your income. And I think what that Harvard study really shows is that even people of substantial means, when they're sort of dependent upon the ebbs and flows of the stock market over time to ensure that they're going to have enough income coming in year over year, that can be a bit of an emotional roller coaster ride versus the people that have guaranteed streams of income that are guaranteed to last as long as they do. Those are the people that tend to have the much softer pillow at night. They tend to have happier retirements. In fact, Stephen Drubner from Freakonomics has studied this for a while. He even said people live longer lives. So not only are they happier, but they have longer lives when they have guaranteed sources of income that last as long as they do, as opposed to relying on positive returns from the stock market to meet all of their income needs in retirement.
I wonder what goes on psychologically with individuals that have those guaranteed income streams. I'm thinking about those high net worth individuals or even lower net worth individuals with big pensions and Social Security. They say, I have enough income. I don't need any guaranteed income because I already have more income than I need. What if they still had a guaranteed income strategy when they don't need the income? What are your thoughts on that? What would that do psychologically for those individuals who don't even need the income?
Yeah, that's a good question. I think that it would be excessive. I think that if you have, me personally, if I had more guaranteed income than I really need, I would wonder if there would be some opportunity cost on that income. I personally feel like if I can guarantee I can guarantee my living expenses, that gives me a permission slip, if you will, to take much more risk in my stock market investments. Why? Because if the stock market goes down in any given year, I'm not constrained to take money out of that stock market portfolio to meet my lifestyle needs. I have the luxury of allowing the stock market to recover before I tap into that portfolio to pay for various discretionary expenses. I call them in my book shock expenses, which is, hey, there's a hole in the roof, or aspirational expenses. I want to take all my grandkids to Disney World. You're not going to feel constrained to tap into your stock market portfolio during a down year to pay for those discretionary expenses. You'll say, hey, I can wait until the next year to pay for that trip to Disney World. And in the meantime, I'm going to give my stock market portfolio a chance to recover. So I think that it would be a hard sell for some people to say you're going to have even more guaranteed income than you need, because in the back of their mind, they're saying, hey, could I be growing this money in a more productive way since I don't necessarily have to tap into it on a yearly basis?
Well, I agree. And the reason I say this is just a client popped into my mind that doesn't need the guaranteed income, but wanted a guaranteed income strategy. They don't draw on the income every year, but they know they have this fallback to do so. And every year we're taking those distributions that were to be income, reallocating them to the market. And their portfolio overall is growing better than those that didn't want any guarantees because of what you just said. They're willing to take more risk. They have something to fall back on in case we have a bad year. It gives them more confidence. And in return, the overall portfolio is growing at a higher rate than if they had a 50-50 stock bond portfolio, for instance. But great insights. Next, I want to talk about the 4 risks lurking in your investment portfolio from your book. You talk about sequence of returns risk, withdrawal rate risk, long-term care risk, inflation risk. Can you hit on each of these individually?
Sure. Sequence of return risk references the order in which you experience returns in your stock market portfolio in retirement. And what all of the studies seem to show is that a sequence of negative returns later on in your retirement is not really a deal breaker, because you only have so many more years to live at that point. And even if you have a couple of down years in a row, it's not going to really be a deal breaker for you. What they really found, though, through all of these different Monte Carlo simulations, is that if you have a sequence of negative returns in the first 10 years of retirement, it can send your stock market portfolio into a death spiral from which it never recovers. And I give an example of that in the book. So, for example, let's say you retired right after the tech bubble burst, like in the year 2000. Then you experienced 3 years of negative stock market returns in a row. And I actually wrote a book on this called The Volatility Shield. Then your portfolio can go bankrupt 15 years earlier than the person that experienced a negative sequence of returns much later in retirement. So the whole point with sequence of return risk is that if by the off chance you were to experience that negative stream of returns early on in retirement, then you could run out of money 15, even 20 years in advance of life expectancy. And at that point, you're trying to get by on Social Security alone. You're limping through the rest of your retirement. So what was turning out to be a very rosy retirement turns into sort of bare bones subsistence type living. And so sequence of return risk is devastating. If you retire at the wrong time and experience that negative sequence of returns in the first 10 years of retirement, it can be absolutely devastating to a retirement plan. You make it past those first 10 years, it's a different story. But if it happens in the first 10 years, it really changes the trajectory of your retirement.
Well, that begs the question, if it's really the first 10 years, some say, Kitts says it's first 15 years of retirement. I think that's the bottom line. And isn't that somewhat of the strategy that you outline in the book for, say, funding the Roth conversions from the taxable funds? So you have this bucket approach that's outlined in the book for those after-tax funds that are going to be left in the market.
Yeah, that's right. So we talk about, hey, look, if you want to mitigate longevity risk and tax rate risk, you can't. One way to mitigate longevity risk is by way of an annuity. Okay. The problem is if you drop that annuity into your tax deferred bucket, which 97% of the people do, you're exposing yourself, number one, to tax rate risk. You're exposing yourself, number two, to the risk of Social Security taxation. Both of those things can cause you to run out of money 10 to 12 years faster than you otherwise would. And so I talk about using the type of annuity that mitigates longevity risk, but also allows you to mitigate tax rate risk. And that's by doing what I call a piecemeal internal Roth conversion, which basically says you got $1 million in your annuity and you want to step it over to the tax-free account so that you're not exposed to a rise in tax rates over time. A lot of companies require you to convert it all in 1 year. And Casey, could you imagine converting a $1 million IRA all in 1 year? I mean, the taxes you'd be taxed at your highest marginal tax rate on most of that money. And so some companies have what I like to call a piecemeal internal Roth conversion, PIRC, which allows you to convert that money to tax-free in any amount that you like over whatever time period your financial plan calls for. So what that allows you to do is to start taking that guaranteed lifetime income out of your tax-free bucket. You're insulated from the impact of rising taxes. And when you take money out of a Roth IRA, it does not count as provisional income. It does not count against the thresholds, which cause Social Security taxation. So the problem is you can't do that Roth conversion all at once. You typically have to spread that Roth conversion out over 5 or 6 years, which means you can't really touch that income until the 6th or 7th year. So that begs the question, how do you pay for lifestyle expenses during the first 6 or 7 years of retirement when you're waiting for that Roth conversion to mature so that you can then take that guaranteed lifetime stream of income out of your annuity? And so I talk about a time segmented approach, which basically says that you can have various segments of investments, various portfolios that mature, that are invested in primarily conservative instruments that mature when you need the money. So for example, if you needed money in the 6th year, you would invest primarily in bonds that mature in the 6th year. If you needed money in the 4th and 5th year, you would invest your money in a segmented account that has bonds that mature in the 4th and 5th year. So by investing in a safe and productive way, and in such a way where you're not likely to lose money, then you can really mitigate sequence of return risk and really eliminate it from your portfolio. So it's something that really is relevant for people who want to participate in that piecemeal internal Roth conversion. They want to eliminate tax rate risk and longevity risk from their portfolio and do it within the very same financial plan.
I think it would be important. Looks like we're going to transition into the strategy from a high level here.
Okay, that is part 1 of my interview with Casey Weed. Thank you for listening once again. If you want to have a little bit of help adopting all of these principles into your retirement plan, you can head over to davidmcknight.com. We will be happy to assist you with that. And if you are an advisor who wants to adopt the Power of Zero worldview, head over to powerofzero.com. Thanks for listening. We will look forward to chatting with you same time next week.